You're tuned in to our Thursday edition of Agriculture Today, and we're glad to have you along. And for the better part of today's program, we're going to have an extended form of our weekly grain market segment, normally featured every Friday on the broadcast, but we'll be away tomorrow, so we move this one day ahead. And we're going to take a broad brush view of the markets in 2021 and the top stories affecting the grain trades. And we've brought in two individuals you've heard from frequently here on the broadcast. Dan O'Brien, grain market economist, K-State Research and Extension, and Guy Allen. Guy is the senior economist with the IGP Institute here at K-State. We thank the both of you for passing your thoughts along to us today. And you have both been churning over what's happened this past 12 months in the grain trades, and have come up with a list of things that you think are primary to steering these markets. And in the first part of our visit, we'll talk about what we're calling the macro issues. And the first one of those, Guy, you say, is what's on everybody's mind, the concerns over the pandemic and the ongoing complications of COVID, right?
Yeah, look, 2021, I think COVID has to come in as the number one story, as it's impacting a large number of issues, or is basically the underlying driver for a lot of the subset of issues driving these commodity markets. 2021's been an interesting year. We've set multi-year highs across most every agricultural commodity. And on a number of commodities, we've set all-time highs. All-time highs we've seen in spring wheat, canola, lumber, palm oil, soybean oil, oats. And, as these prices set new highs, it's providing some optimism as we finish the year, as well as we move into the new year coming. But I think this COVID thing's going to continue to hang around, sort of like a bad cold or bad flu for the next year, or maybe even a bit further than that. And one thing I think COVID done is it's sort of expedited and sped up a lot of particularly supply chain changes that were coming anyway, but it's just increased the speed at which that's impacted things, particularly on the international front.
When we talk about something as broad and as sweeping as COVID, Dan, it's hard to attach a day-to-day or week-to-week impact to market activity and movement here, but it's definitely an influence.
It's gummed up the works in terms of logistics. People not having labor available at key points. We saw some aspect of this tied in with the port issue out in Los Angeles, labor issues, regulations, all in play there, and that had impacts, of course, for the overall U.S. economy, but also on the ag side. And I think where we see it is on nuts and bolts things like getting parts for repairs, or getting herbicides from this shop to that, and getting machinery, keeping machinery up and running. So an issue all over the place. And Guy, from your international experiences, dealing with shipments out of Australia, out of China, no doubt it's had impacts there. So I just think that with the impacts on labor that slowed things down, we've just seen a lack of efficiency, I guess, in being able to move product and get it to where it needs to be.
Yeah, no, exactly. And I think as we go across these subjects, we're going to drill down into that in a bit deeper on a couple points later.
We will do that very thing. Another thing on the list of macro issues impacting the grain trades, inflation. That's on everybody's minds as well. 40-year high. And Guy, this is an ongoing story. It's certainly not.
Yeah, this is an ongoing story. And if you're sort of a macroeconomist, you're watching this pretty close. Look, we've seen a historical increase in the U.S. money supply, more than 40% in the last 18 months. Part of it being a COVID stimulus. We've got a Congress that is very fond at spending money like a drunken sailor. No insult to drunken sailors. I think they're a bit more conservative than Congress is at the moment. But that's going to have a significant impact on prices. take exception with some of my economists who thinks this inflationary is transitory. You can't increase the money supply to that extent without having significant inflationary pressures. And we're just starting to see that come in the last few months, and I think it's going to exist for a couple of years to work through that. And that's being reflected in commodity prices, particularly in the base cost of food. I was looking at some numbers just this week. If you're looking at your Christmas holiday dinner, prices are going to be up significantly. Your Christmas turkey is up 27% higher than last year. If you're having a holiday ham, it could be up significantly there as well, along with beef and your other meats. Interesting, your bread products are up as well, following not only the price of wheat higher, but the cost of transportation and energy. The only, optimal or good news on your dinner plate is the cost of vegetables. They really haven't gone up at all. So as my mother said, eat your vegetables for your holiday dinner this year.
Dan, how do you interpret directly the influence of inflation on the grain markets on a day-to-day, week-to-week, month-to-month basis?
Inflation is a great thing if it only hits the selling side of what we're dealing with. And we'll talk here later as time allows on the fertilizer cost inflation that we've seen, et cetera. But just to look at what's happened in this past year for corn futures, we started out the year at right around 525, 530, something like that, ran up to a high in May of about 735, came down to a low of about $5, are now hanging around $6, thereabouts, as we speak this week. For wheat's just been an amazingly inflated situation, and in spite of us not having a whole lot of wheat exports, we're kind of dragging, but it's the world wheat market. And again, futures about 650 at the January of 2021, and then it's like we've seesawed. We went up to about 770, down to 609, up to 778, down to 677, up to 875. Now sitting at around 850. So inflation without question. And some of what Guy is talking about in terms of overall financial markets are in play there. They're as financial markets are affected, then the commodities come into play. Now, soybeans, out of what we've talked about, it's probably they've seen inflationary pressures, but a lot of volatility in the upside. Started the year at about 1325 thereabouts, at successive highs up to 1460, the high about 1667, came down to 1181, are now sitting at about, as we speak here recently, we're trading somewhere around 1329. So we talked about inflation, Guy, but what's amazing is the volatility. Just amazing volatility. And we're actually right now seeing the low end of it. In the spring, we saw just volatility levels that were historic. So it really makes farm planners, the people that finance farms in the US and all over the world, it puts them in a very risky situation. And the thing that would work out worst for farmers here and abroad is to pay high prices for inflationary cost of production, and then end up on a down cycle at the end of 2022, and at a time when we're trying to pay for all this stuff. So challenging.
Yeah, that volatility is a good point. And as I went through where we made the annual highs on a lot of these commodities, it was actually during the spring planting period between March and June, and as it competed for acres. And I thought we saw pretty good competition for planted acres last year, but I think we're going to see even more competition to buy in acres between the commodities, particularly corn, soybeans, spring wheat, cotton, and grain sorghum is going to be in that mix as well. So I expect some spring volatility going forward.
Another of these macro issues that we want to highlight here, and Guy, just recently on the broadcast, we got into depth on this, the high cost of ocean freight. That may have tempered some of late, as we discussed, but it's still a primary concern.
Yeah, looking at our international costs, our international customers and their buying patterns here. That high cost of ocean freight is a significant cost of their imports. Look, we reached an 11-year high on the Baltic Dry Freight Index in October. Since then, we've dropped, and that was a high of 5,650. Since then, we've dropped that back today to lower values. I think that's coming in just about 2,600. Significant drop back in the last month. But that cost of freight has been volatile, and it's an important component of the cost of goods to our import buyers. And I think that's one reason we've seen fairly slow exports to start off the year. Given our distance from other markets such as Black Sea, Australia, and Europe, we're freight disadvantaged, and the higher freight rates just exaggerate that comparative disadvantage the U.S. has.
I would add into that, where we've dropped down to now is what we used to consider high. so that run up, the guy that you're talking about, was extraordinary. But and now we're still showing inflation. We're at what we used to consider a high level for the Baltic Freight Index.
Yeah.
So the costs of shipping have climbed appreciably, to say the least, and then complicating it further, the overall difficulties in moving products, supply chain problems, they make the list here for sure, don't they?
Yeah, we might touch base on point 4, which is the intermodal transportation, before we go to the supply chain issues. But look, container freight, it's a different market, it's a different mode of moving stuff, and its challenges because of COVID have been really exaggerated. We touched on this in the beginning. Your container freight index has more than quadrupled from a year ago throughout the whole year, with added volatility. For the backhaul situations where grain moves, it's more than double. And the real challenge has been availability of containers on that. And to sort of move into point 5, into the supply chain situation, the problem just isn't at the port. Whenever they talk about supply chain, they like to show you pictures of boats lined up off of Los Angeles and Long Beach. But I think the real issue is probably the underlying labor, local transportation, not only for discharge, but also for loading and getting the product warehoused and moved to its subsequent destination, or get the product moved to its point of loading. And that's what's really complicating the situation.
And when you think about the influences at the farm gate, Dan, and we're seeing some of that play out already, likely more in 2022, the availability of inputs for crop production is worrisome to producers.
Yes, I want to add one point on what Guy just said also. Distillers grains often shipped by those containers, and when you look at the market for DDGs, it's not desolate, but it has come down from the time earlier on in the year when a lot of those DDGs were heading off to China. So so back to what you're saying, Eric, the supply chain issues tie in with the fertilizer cost issues and the general challenges that we have. If there's a worrisome, to me, a worrisome situation, it's that with the prices of a lot of goods, farm inputs rising so much, I've heard a lot of folks talking about, well, they're too expensive to buy. I'll wait until spring. I'll wait until winter to see them come down. They may come down and they may not. So given that the dependency of our crop production systems on these key inputs, fertilizer, especially for feed grains, and a lot of the herbicides, et cetera, on the one hand, we don't want to say the sky is falling and that we can't, that economic forces won't be so strong that they'll solve this problem. They're working to solve the problem. But if we get ourselves in a hole and we just cannot get these key inputs at all, then Guy, we come back to those acreage issues, and we really there's just a lot of risk heading off into spring, not just with the normal weather, but whether we have the inputs to be able to plant these crops that we're hoping to plant.
Yeah, just highlight one point there is a key input is labor. And one thing this COVID situation has done, it's sort of I think expedited the fact that we've got a declining demographics in the population of younger people versus retiring people, particularly us being the baby boomers and some of us retiring shortly. We're not getting that replacement of younger workers coming in. And that's probably more true in a lot of the countries outside of the US. And that tightness in the labor supply we're seeing in higher labor costs, that's fueling the increase in prices, as well as is a real problem along that whole supply chain.
The final macro topic that we'll get into today, and this is something that is boiling and has been for a time anyway, as we're so reliant on the People's Republic of China for export grain business. And the political tensions that are rising there over, well, largely Taiwan. Well, Guy, those, and you've been a student of the China market for a long while, those are serious situations.
Yeah, look, if there's one issue that keeps me awake at night, I think it's the potential impact of a military move by the People's Republic of China on Taiwan, and that would extend into the greater South China Sea situation. I'm old enough to remember the Afghanistan situation back in 1979 and the impacts that on the commodity market. It took a booming commodity market down to relatively historically low levels overnight, and that could reoccur. One conversation I have with a lot of CEO and senior executives is, have you had a discussion with your risk committee or your executive on what's your contingency plan for such a situation if you wake up in the morning? China's been very, very clear. They intend to incorporate Taiwan back within the People's Republic of China under President Xi's term at some point. And I fully believe that's their intent. How they get that done and accomplish it's question, but that situation just continues to increase in tension, and we'll just pay a very, very close attention to it as we move forward.
And boy, you're putting I'm speaking in an area that again, I'm not trained to work in the State Department, but on the one hand, you have the Olympics happening in China that it's unlikely that something happened before that. Trailing that, you have major U.S. presidential elections happening in not too long. So you can see a window out there where there's concern that something's going to happen, that it could happen. I would say also China, where it can, it's shown here of late, Guy, at least I think we've seen for corn and for soybeans, if they can go elsewhere to get them, they'll go, and even for soybeans, even pay higher prices. But that doesn't mean that they're still not very active and that they don't have purchases ahead. They do on these commodities, but on the day-to-day, week-to-week basis, week-to-week basis, in terms of seeing where they're buying from, it seems if they have the opportunity to buy from Ukraine for corn, or to book ahead for South America, to buy from Argentina. Argentina ships their supplies of soybeans to them and then buys back from somebody else. You've got them seeking to where they can lessen their dependency on the U.S., perhaps in anticipation of some of these things. Guy, am I thinking correctly?
Well, yeah, I think there's two things there. One, I think they do definitely run their political agendas with their commercial agendas. We've got to keep in mind China is the biggest buyer of number of commodities, including oil seeds, cotton, corn. Last year, they became the largest buyer. Part of that, I'd suggest, Dan, is a freight advantage. Unless they're coming out of Brazil or South America, I think that's a preference. The other thing, when you look at the U.S. long term, the U.S. has always been the residual supplier of grain, and that's due to market structure and our capacity to actually carry grain from one season to the next, rather than trying to have to clear a market every year, where countries such as South America and other places sort of want to clear that exportable surplus. So there's a number of dynamics there. I'd actually go so far as to suggest, though, China actually has to come to the U.S. for a number of those commodities. They don't have a choice. So that's sort of a good thing. And I sort of would like to think maybe that tightness in existing food and energy supplies is maybe tempering China's attitude in that South China Sea and Taiwan situation a bit. Their biggest concern is, number one, securing a safe, stable food supply for 1.4 billion people.
Well, this is an issue which will bear extraordinarily close watching, obviously, as 2022 unfolds. We do need to take a break. When we come back, gentlemen, we would bring up what we're calling the micro issues, La Nina among them, and other things, which we'll cover here in just a second. Our guests providing this overview of the top grain and oilseed market stories of 2021, Guy Allen of the IGP Institute at K-State, and K-State Research and Extension grain market economist Dan O'Brien. They'll return shortly on Agriculture Today.